Volatility can be a blessing or a curse for traders. I found that when leveraged incorrectly, it's really the thing that kills most accounts. But when leveraged correctly, I think volatility can serve as a very useful tool to help you take advantage of some trade opportunities that don't normally present themselves. In today's video, we're going to be doing just that. We'll use our live scanner. This is our stock Volatility Box live scanner, and we're going to focus on the overlap tab. This is our best of the best type of tab here. It combines the hourly and the daily, looks for overlaps between the two, and it gives us a list. Now for context, typically on this tab, we see something like maybe 5, maybe 10 stocks. Today, we had many more than 10 stocks, and we had some large names that also hit our scanner. Stocks like Oracle. The ones that we're going to pay attention to, however, SBUX and Microsoft, but we also had the Qs hit, we had BABA, we had Qualcomm, we had XLU as an ETF. There were lots of different options for you to take advantage of a volatility edge today. So let's start with taking a look at SBUX. We'll move on next to Microsoft, and my goal through both of those stocks is to show you how to take advantage of volatility, especially as we are chopping towards this top end of this channel inside of the S&P 500. If we do start to make our next leg down lower, I imagine that's going to lead to an increase in volatility, and we'll see many more such opportunities on our live scanner. Now let's start first with SBUX, so SBUX, and I'll come into a 5-minute time frame chart. This is what SBUX looked like. Now we hit the live scanner first, the aggressive right here, and we then hit the conservative right here. Now, as we're falling here on the 5-minute time frame chart, we can see we have Keltner channel wedges that are starting to plot as well as we hit the conservative box. So first we know we have a volatility edge right here, price is hitting our volatility levels where we expect price to react from. As we're doing that, we're also seeing we're extended using Keltner channels. That's the 3.0 Keltner channel wedges telling us we're outside of the 3.0 lower bands. We see the Keltner channel wedges stop printing. We see our oversold confirmation signal, that's the edge signal right here, and we see our momentum cross with the 3 EMA crossing above the 8 EMA. This blue dot is really that, hey, we're waiting for confirmation entry. The edge signal is your, hey, I'm just waiting for oversold confirmations and I'm looking to try and get in early. Now in both of these cases, we can see we had one real candle of heat from the entry point using the closing price, but beyond that, price action just started to naturally grind higher. This was a very systematic trade. Inside of SBUX, I was looking at the 100 calls, and those calls went from 220 at the time of entry. That was actually right here, and that went all the way up to about 250 when I was looking at getting at, and that was in this pump right here, and it went even higher at certain points in the second leg move up. So I thought that was very interesting, is the idea of buying calls here as price action's falling. The calls are cheaper. You're looking to take advantage of that in some of these larger names, which we don't usually have the luxury of. And in there, you have the ability to play these options in a way that I think makes a lot more sense compared to, say, the underlying. For example, if we come inside of SBUX and we use the 100 calls today, they're the ones that had the largest volume right here. Largest volume, largest open interest. We copy the code, and we take a look at the same indicator set here, you still see a very similar setup, and I think you get that luxury only with options that do have some sort of liquidity. Same Keltner channel wedges that are plotting, same oversold confirmation signal, same momentum trigger in that same candle along with another one right here as well. And you get a chance to really see what that measurement looks like in terms of options pricing. When the entry was there, it was about 220. I told you about 250, went all the way up to about 288 in terms of the max pricing in that second leg higher. So that was SBUX, a very nice, clean setup. Now, very similar to SBUX, we also had Microsoft. Same idea inside of Microsoft. Price fell inside of the volatility box, first the aggressive, then the conservative. We have it hit our scanner. We know we're breaching the hourly models as well. We have Keltner channel wedges, 1, 2, 3, 4, 5. We also see after that our edge signal confirmation along with the momentum cross, that 3 crossing the 8. And after this candle right here, really very little heat. You might say this was the heat right here, these 3 large candles, but even that was a return back to the entry price. However, what is interesting is if at the same time, if we use the 255 calls in Microsoft, same notion. So 255 calls, copy. What should stand out here is the setup is a lot cleaner. There's more liquidity on the options. The candles look a little bit nicer, but more so, when that little second pullback comes in, the options pricing dips below even the actual entry price. I thought that was somewhat interesting. $4 compared to near the entry price, at least using the option setup, at $4.18. So that second leg down lower inside of Microsoft, while on the underlying, you might have been at a break-even price. On the options, you were a little bit underwater there in this little pullback right here. So a little bit interesting inside of Microsoft, but otherwise, same idea, same setup. We have price tell us we're extended from the Volatility Box edges. We're extended from the hourly plus the daily models. We're then looking for these Keltner channel wedges. We have those form, at least 5 of them. We have our oversold confirmation signal. We also have momentum telling us that, hey, we're looking at this move to really start to get going. And then from that point, for the rest of the day, we just chop inside of this very tight channel, which so far is still valid as we head into tomorrow's activity. This is a very tight channel though, so that's probably going to be broken probably first thing in the morning tomorrow, or maybe even pre-market. Alright, well, hopefully through today's video, you got an understanding of how to really outsource the job of finding some nice volatility candidates, places where you have a volatility edge, letting our scanner do a lot of the heavy lifting for you. We use the overlap tab today, but typically when we say have maybe 5 to 10 candidates here, we also have the luxury of knowing where price is giving us an hourly volatility edge, along with a daily volatility edge. This is using each respective model, and there you can find even more candidates, which in today's case, it was most definitely a volatility increase that took place. If we take a look at the 15-day scanner stats here, we can see just how large today was in terms of a volatility gap. Last time we saw something similar was November 30th. So that should put everything into perspective, give you an idea of what to expect as we head into this new year, and how to take advantage of this volatility if we see it continuing to increase as we go closer and closer. Take care, everyone. Good luck trading, and I'll see you in the next update.